Welcome to Investing Path, where we bring you insightful information to help you navigate the complex world of finance. Today, we're going to explore a recent interview with Jamie Dimon, the CEO of JP Morgan Chase on CNN, where he talked about the current economic storm that is looming on the horizon. As Dimon warned us earlier this year, the storm clouds have gathered and the economy is facing some serious challenges. While things may seem sunny right now, the reality is that the hurricane is approaching, and we need to be prepared. In a recent media appearance, Diamond shared why he believed that the problems in the economy are far from over, and it all has to do with something that happened on the 1st of June 2022. Last year was an unprecedented year that saw a war, record inflation, rapid interest rate hikes, and a stock market collapse. Despite these challenges, unemployment remained at record lows and consumers continued to spend at unprecedented levels, fueled by trillions of dollars in their checking accounts. However, Diamond sees dark storm clouds circling overhead, and while we cannot predict exactly what the economic weather will look like, we can explore the major factors that have raised the probability of further trouble coming down the road. Jamie Dimon is a prominent figure in the finance world and the CEO of America's largest bank, JP Morgan Chase, which is also the fifth largest bank in the world. Diamond has a personal fortune of about $2 billion, and he has acquired 9 million shares of JP Morgan during his 17-year tenure at the top of the company. We turn to Diamond for his expertise in macroeconomics, not because he can predict the future, but because he has a solid understanding of the key factors that impact the economy's ups and downs. As we dive deeper into Diamond's shareholder letter, we find that the events of 2022 were anything but normal. As he put it, these events are rarely one-time things that go away quickly. The pandemic has left us with long-lasting effects on the economy that will take years to resolve. The war in Ukraine, which began in 2022, added to the inflation pressures that were already building up from the COVID stimulus spending. As a result, the inflation rate in the US surged to a 40-year high of 9%, which was more than 4 times higher than the annual rate in 2019. To counteract the unusual acceleration of inflation, the Federal Reserve responded with swift monetary policy adjustment. They began increasing the federal funds rate in March, which climbed to over 4% by the end of the year. This led to a stock market collapse of around 20%, with several popular stocks seeing even worse performances. In fact, some of the biggest names in the industry were among the top 20 worst performing stocks in 2022. Tesla and Meta platforms both experienced a significant drop of 65%. It is a clear indication that the storm clouds that Diamond warned us about are already making their presence felt. We've been hearing a lot from Diamond lately about the economic challenges that lie ahead in the aftermath of the COVID-19 pandemic. These challenges are not fleeting events that come and go quickly, but rather they are more like changes in the tide that occur over several years. We're currently experiencing the first part of this shift, which began in 2022. Diamond's recent shareholder letter discusses the unusual event that we experienced last year. He notes that the 2022 was not normal, economically speaking, and points to the war in Ukraine, which began and continued throughout the year, as one of the factors contributing to the growing inflation pressures already building as an after effect of COVID stimulus spending. Inflation reached a 40-year high in the US, rising by 9%, a more than four-fold increase in the annual rate since 2019. The acceleration of inflation led to an unusually fast monetary policy response from the Federal Reserve, which began to increase the federal funds rate from 0.1% to over 4% by the end of the year. The stock market dropped by around 20%, with many popular stocks seeing much worse performance, including recognizable names such as Tesla, Meta Platforms, and Warner Bros. Discovery. To add the unusual events of 2022, the yield curve for US Treasury bonds inverted, a rare circumstance that predicts a recession, and has done so in 8 out of the last recessions. But despite all this, the economy is still running well as we enter the second quarter of 2023. Consumers are spending 23% more than pre-COVID-19. Unemployment is low, and wages are rising, making this economic situation different from one we faced in 2008. However, despite of these positive signs, Diamond warns of dark storm clouds looming overhead. If the economic conditions deteriorate over the next 12 months, it will likely have a lot to do with something that happened on June 1st, 2022. Though he doesn't specify what this event was, Diamond notes that quantitative tightening and inflation higher for longer are concerns that could impact the long-term rates. He also mentions the war in Ukraine as another potential threat. Regardless, we know that this in the business, worry is ever present and we must stay vigilant. As we look ahead to the economy in 2023, there are two major concerns that we need to keep in mind. The first is the ongoing war in Ukraine, which could have significant implications for global financial markets. The second is quantitative tightening, which is a monetary policy tool used by the Federal Reserve to tighten financial conditions. This is the second main lever that the Fed can pull to slow the economy after raising interest rates. To understand quantitative tightening, it is important to know that raising the federal funds rate is how the Federal Reserve controls short-term borrowing rates in the United States. However, this rate has less of a direct impact on long-term borrowing rates, which can be influenced by other factors. That is where quantitative easing and tightening come in. The Fed uses these tools to buy and sell treasury bonds or other securities to either push new money into the markets or pull some of it out. For over a decade, the US has experienced quantitative easing, which drove interest rates down to virtually zero. However, since June 2022, the Fed has switched to quantitative tightening. They're now selling back some of the treasury bonds they acquired, essentially sucking money out of the financial market. We believe that not enough people are paying attention to quantitative tightening as a significant element of monetary policy. While the Fed can control short-term interest rates directly, they do not completely control long-term rates and liquidity, which are influenced by both supply and demand, and global investor preferences and sentiment. Even if the Fed stops raising interest rates, it is entirely possible that long-term bonds such as the 10-year US bonds will continue to see their yields rise. One major factor that affects long-term interest rates is global investor sentiment. The Fed's decision to sell government bonds and reduce their balance sheet could lead to a rise in long-term bonds yields. At the same time, global investor sentiment, supply and demand could also influence these rates. Ultimately, the Fed does not directly control longer rates, and we cannot predict how global investors will react. In summary, while the Fed's decision to raise or lower interest rates can affect short-term borrowing rates, we must also pay attention to quantitative tightening and its impact on long-term interest rates. The global financial landscape is complex, and we cannot predict how various factors will influence the economy. However, by keeping a watchful eye on both quantitative tightening and the ongoing situation in Ukraine, we can be better prepared for whatever lies ahead. As of now, thank you for tuning in to Investing Path, where we explore the world of finance and investing. Now, before we end this video, we wanted to address a question that's been on everyone's mind. Will there be a recession? As we've discussed earlier in this video, the yield curve inversion has historically been the most accurate indicator of a recession coming in the near future. However, our guest speaker, Diamond, believes that this time might be different due to quantitative tightening. Long-term bond rates aren't controlled by the Federal Reserve, but they were driven to rock bottom due to the huge amount of quantitative easing that the Fed did since 2020. So, it is entirely possible that the yield curve inversion that we see is the result of QE since 2020, pushing down long rates, and the recent rate hikes are driving up short rates. And of course, this still makes the yield curve negative, but it's been pushed negative for a completely different reason than in the past. So, while it is entirely possible that investor sentiment is playing a role in the current negative yield curve, it is important to recognize that sometimes there are different things happening, and an indicator like the negative yield curve is never something you should rely on for your investment decisions. Remember, as a long-term investor with a long-term view, no matter how bad inflation or other economic factors may seem at that time, what is happening right now will end up just being another speck in the rearview mirror of a growing American and global economy. Thank you for watching Investing Path, and we'll see you in the next video.